Greetings, traders and Eclipse viewers. Coming up, hopefully, some of you across the United States here or across the world get a chance and an opportunity to see it. I'm in Massachusetts. It's going to be bouncing on here in about another hour, so hopefully, we're going to take a peek at it. Welcome, Hoag. Welcome, Anne Marie. It's maybe about 2 weeks since we were all together. It was a blast last time. Looking forward to it again today, and we're actually going to bookend this week because we're going to do it again on Friday. So this is Strategy Lab with Anne Marie with Hoag. Hoag, give you your voice to rest there. We're going to get right back into you. Anne Marie, how are you doing?
I am doing very well. I am a super science nerd, so I've been really looking forward to the eclipse today. I've been watching the telescope on NASA because I think on the south coast of Florida, which is where I sit, we have about I think it's maybe 64 or 74, something like that, right on the edge. And so I've been looking at the NASA telescopes, watching it. So it's about a total eclipse at Mazatlan right now.
Mm-hmm.
So
right now,
yeah.
Nice,
So
nice. There you go. We get about a 98% up here in Mass, so I'll be definitely looking forward to that. There's two of us that work in Mass that work for Topstep. So myself and Tim, both on TopstepTV. So we'll be bouncing aside for a minute. I hope everybody else has seen it too. And enough of that. But I guess today on Strategy Lab, we're going to do some talking about some different types of gaps. And I think you have some input for us and some maybe some resources that we can go and we can take a look at. So a gap, there's a couple of them. You have like gaps between candles. We have gaps from the close of one day to the open of the next. That's literally the day to an hour later for the Asian market. And then we have daily gaps where did the US market close and where did it open today? And all kinds of opportunities for potentially trade there. So Emery, you want to start with that? And then I think Sean's got a couple of charts loaded up that we'll take a look at as well. So please.
You moved the chart over there. So last week, Austin, who's one of our guys that's come over from Forex space, he was talking about different types of stats that he likes to look at, and he mentioned this place called Edgeful. And so what I did was I took a look at these, not the gap fills, but the opening ranges to see what happens and to see how it happens by weekday, which is super interesting. So we spend a lot of time trading gaps, and we'll either call them, and help me with this, Hoag, we'll call them it'll tell us that the market is actively looking for new prices, either higher or lower, and that's when we get out of the range of the prior day. Is that correct? Yes? Okay. And
yes.
So
it's a form of imbalance.
There we go. And so help me with that definition again. If we're out of balance, it means that traders are going to be hunting for higher prices or lower prices, correct?
Yeah, like the market opens outside of the previous day's regular trading hour range. That's what I consider a gap. So it is saying that there's a probability that something has changed overnight with the collective perception of value. And when we open with that gap, typically one of two things is going to happen. It's either going to leave that gap at the end of the day and continue in the direction of the gap, or it may close the gap and then continue in the direction of the gap, or price may come back into the previous day's range in balance and perhaps leave the daily range overlapping to higher. And the least of all probabilities is if we were to open above a previous day's range and then close a day below that previous day's range. And if you're in an uptrend and that happens, that would be considered a key reversal day.
Yes. Okay.
A bearish engulfing pattern, something like that. So would be something you would call something like that.
Okay. And so what was super interesting about these sorts of gaps, I wanted to sort of dovetail it into our look at the markets where you trade that 1 minute formation versus something that's a fair bit wider, and how we might play around with some strategies associated with that. So you said you had something on T2 that you could show us? T4. Sorry.
Yes.
Yes.
So what Anne Marie is talking about is the opening range, which I typically, for consistency's sake and for risk management's sake, use a 1 minute opening range. Now, what's an opening range? Well, back in the day in the trading pit, before electronic trading, all of the trading had to occur inside the regular trading hours. In the S&Ps, that was 8:30. The opening range was established after all of the brokers around the trading pit had completed all the orders that were due fills right on the open. If it was a slow day, that it may be, just a handle wide, 4 ticks wide, and only take 36 seconds to finish. If it was a very busy day, it may take 5 minutes and several handles of price range with which to finish filling all those orders that were due fills on the open. So the exchange would then take a look at the range, and they would bring a piece of paper around to all the brokers and say, okay, we think the opening range should be from here to here. And if you filled all your orders that were due fills on the open between those two levels, you would say, I agree. If you traded outside of there, you'd say, no, I need the opening range to go actually, 2 ticks higher, because that's where I had an execution during the opening range. So I didn't have to adjust anything to my customers because I filled their orders outside of the opening range. So, the context of the opening range in pit, it was human. If there were a lot of orders to be traded, it may take 5 minutes to finish the opening range. In electronic trading, if there's something somebody wants to get done right away, they have to click a button. So that's why I've kind of rat-holed my opening range to 1 minute. I think 1 minute is plenty of time for somebody that wants to get something done in electronic trading, right on the open, get it done, no problem. But I know that there are a lot of other people out there that look at the opening range in different time frames. Some maybe 2 minutes, some maybe 5 minutes, some maybe 15 minutes, some even 30 minutes, and some would even call the initial balance an opening range. But that all that does when you expand that time frame is to expand the risk. Okay, Anne-Marie.
Exactly.
Yes.
That's exactly right. And Hoag, to add on to that, trading the gaps, it's something I really started out with myself, was taking the gaps, really just, you can call them fading them, gap fills, whatever you want. I actually started doing that as well as the opening range. And the point I want to make here is that the opening ranges are could be different per trader, per instrument. Opening range of London on NQ, if you're trading that, you may have a really different approach than the opening range on, let's say, oil during the US market. So we need to take all of this in context. I just want to be clear on that, because even though you have different opening ranges, some traders, like you said, use 1, some use 5, some use 15, and some just use the hour opening initial balance of the first hour. It really matters based on the trader, right? And again, in the instrument, your risk tolerance and everything else. So it's not a hard and fast set rule. And you also said one more thing, Hoag, I want to make sure everybody catches on to. I am an opening range trader. I only trade the ES and I trade a 1 minute opening range. Well, I'm going to trade it different if it's 2 ticks or 20 points, right? So we need to be able to go with the flow and make sure we have a plan around what if this, what if that, and how are you going to trade these different scenarios, rather than just a hard set rule. It's like, hey, if it goes out of the opening range, I'm going long. Well, if it's 30 points, you may not want to. If it's 2 ticks, you may not even want to trade it.
Right.
Well, let's see what the opening balance looks like. So just the different variations and options around the opening range trades. I would like to get back to the different types of gaps, and especially what we're going to have with Anne-Marie. We'll look at my chart right now. I'm going to show one quick little thing and then kick it back over to Anne-Marie. I marked 2 areas. This is just a Dow 5 minute, because I had it up in my chart. This here I've highlighted. This is from Friday's close to today's Asia open. And I'm just eyeballing here. I know it's not specific. So what I would like to do with this is, if I'm interested in taking and fading this gap, well, I'm going to short into it when it breaks and have my target down below. And as we can see, we did get entered right here if I took this. And my target is, I'm saying right here, let me get the levels for you. It was right around 39 to 80, and the target is right around 247. So that's what I would be entering. So that was my entry point. Now, if I'm doing a one-to-one, it's pretty straightforward. Again, I'm just going to eyeball the size of this, but there would be roughly a one-to-one ratio where I'm entering here. My stop is above at like 307, and my target is down here. And lo and behold, it did fill that gap. It looks like about 7:30 Central Time. The second gap I just plotted on this chart is there's the close of yesterday's market, and then I also plotted the open of the U.S. market, which was roughly in this area, which is 281, roughly. Just again, just eyeballing this. And what if I wanted to fade that gap? Well, guess what? Would have entered, should say. My stop was 1-to-1 ratio was right around 314, 15. And the target was the same because I'm targeting that area. So if you wanted to trade both of those scenarios, your Asia fade gap or your US gap fade to the previous day, those are two really good solid trades. Do they work every time? Hell no, of course not. But that's how we have risks in place. And I kind of wanted to show the difference. And I happen to have YM. We can look at any other instrument if chat wants to see one while Anne-Marie is going through that other site that you were talking about. There was more information on there. So I'd like to kick it back over to you to finish up with that.
Sure thing. And so we could even look at the YM. What's super interesting about these, a long time ago, when I was really learning different things from my toolkit, I started learning the gap trade. And so there is a guy, and his first name is Scott, but they called him the gap guy. And he probably is still out there. He's just done a tremendous stuff. All he does is trade the gaps. If there's not a gap, he doesn't trade it. As soon as the gap fills, he leaves. And he's got a few things on how gaps will fill. But what I found really interesting was I just took a look at from January to current to April. It's the first trading day in January, or maybe just a couple of days after, by the ES. And we can see that on Mondays, get this, for a gap up, 62% of them aren't filled. And for a gap down, 60% of them are not filled. And so it's telling us that we have trending going on in the market, right? The gap doesn't fill because the gap stays and the market continues down based on, whatever it is that's going on in the broad market. And when we look at that from the trading formations that you set up for us, John, like here, as we're staring down these profiles, when you look at those 1 minutes, if we notice that, Mondays and Fridays have a tendency to, that's interesting about Fridays. That's
See if we get Anne-Marie's chart up there if it's possible.
Okay, so take a look at this interesting thing right here. This is just this month, this is just from January to April. And so these are all the gaps that get filled. On Monday, 62% and then 60% if it's gapping down or gapping up. So that tells us, hey, we've got trending motion that's likely on Monday, which has a tendency to reinforce John's opening tick trade for that opening 1 minute. If it gaps down or if it gaps up, it gives more power to the fact that John's opening range trade break is going to have more legs. On Tuesdays, check this out. Since the year started, every single gap that's occurred on Tuesdays has been filled. Gap up. Every gap up has been filled. Take a look at Fridays. For Fridays, you'd think that because Fridays, I think I always in my mind think, hey, Fridays are trending. My mind seems to gravitate to that, but this says that's not the case. It says that gaps up are usually filled, 63%, gaps down, 75% of them are filled, saying that, hey,
On a
the
Friday.
market, a little bit more bullish. So if you've got an opening range trade on Friday that gaps down, there's only a 25% chance that it's actually going to continue down without coming back to fill into that opening range. So this is a really, go ahead.
And Marie, let me ask you, how are they defining a gap?
Okay, so great. So a gap is the 9:30 open and the settlement price for closing. So that's how they're whatever is whatever the settlement is, and then 9:30 open. So they're using no, I shouldn't say settlement. The 4 p.m. close and a 9:30 open is what they're using for their stats here. They're not using Globex.
In essence, basically settlement.
Yes.
So a gap in this regard is not necessarily a market that opens outside of the previous day's range. It's anytime it's away from settlement or 3 o'clock close. Okay.
Yes. Yes.
Yeah, that's exactly what I used to trade, John, the same way, just going that exact way. It was like, hey, what was the price? Settlement price, closing price are so close. It's irrelevant, but it's really close. And they, all right, great. Our U.S. market opened at this level. This is the distance. And then you need to make your adjustments there. So at the time trading NQ, if it was 150 points, it's a little too steep for me. So I'll wait for something else. If it's 50 or 40 or 30, it's probably going to close right off the bat.
John, I know what you're going after right there. I saw what you were saying right there. So let's dig down on what John's actually saying. And please tell me if I got this off track. But what John is saying is, hey, listen, the data that you're looking at is not quite going to be in line with what an opening range trade looks like if the opening range trade is made and it's in value and in range. Is that what you were after?
Kind of, yeah, because I know that there's different ways that people will gauge a gap. Most of the time, to me, the market has to open outside of the previous day's range. A close to the one extreme of the previous day's range closes the gap. Not all the way to settlement, just to one extreme or the other of the previous day. So, like...
Okay, so while you're going through that, let me ask you this. You've been killing these opening range trades lately. You've had some really pretty ones that you've taken. Is there, if something is in range and in value, does it affect how you view? Yes.
Yes.
Okay,
yes.
Help us understand how.
Okay. Today, there was no range. There was, we opened right in the middle of Friday's area of value. As a matter of fact, you can even see it here on this. Here's Friday's value high, Friday's value low. We can say that it's 52.35 to 52.68. Our overnight high, very close to 52.68, the value area high. Okay, the overnight high was 52.69 quarter, within a few ticks of the value high from Friday. The overnight low was 52.36.50. Value low from Friday was 36.55 half. So 4 ticks away. So we've already got an inside day and an inside value area day by the time the market opens up in regular trading hours. The market opens, doesn't leave the opening range at either extreme, which is what I would be looking for in this case. Trades to value high from yesterday, to 52.68.50, went 1 tick above it, turns around, and then comes back and retests the low of the initial balance, leaves a failed auction at the bottom. Where does that failed auction go to? Overnight value low, doesn't even get to Friday's value low, and then comes back inside the initial balance, which creates a rotational day because S&Ps have traded above the initial balance and below the initial balance. And for all of you that don't know the initial balance is this dark blue line here, and it represents the first hour of the regular trading hour session. Okay. So this is the overnight profile. This is the regular trading hour profile. Okay. So when I saw this morning, I said, well, I'm probably not going to be doing much today. And if I am, I'm going to let the market establish some extremes, and I'm going to fade those extremes. Unless something breaks out, I can print money all day. Bam, 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 back and forth. Right. So now let's go back to this one. This was Friday's profile, right? Thursday, we had the big dump day. Opening range is dead ass low. But it closed in range, but out of value in a market that exhibited a lack of balance at the end of the day, the previous day. So this was an opening range trade I was going to take. This one, not so much.
Gotcha. Okay. All right.
So, and then when it comes to ranges, this was the first and the second. The range was, the low of the range here was 52.82. The opening range actually ended up being a decent opportunity, but not an entire day and not an all day sucker. The high of the initial balance was 52.55 even. It was left at the high of the day until the very end of the day. This was a very small range, but it never did close the gap. So when it doesn't close the gap and leaves the opening range at the high of the day, this is a day that I'm looking for shorts. Does it play out for me? Not at the end of the day. The next day we opened in range and in value, but we had an opening range to the downside that failed. We have an opening range to the upside that succeeds. But most of the time, I'm probably not going to be taking an opening range trade if it's right in the middle of value from the previous day. It's saying on the open that there's very little change to the perception of value here. And you can see later on in the session here, the market did offer opportunity to come back into the opening range at the end of the day. And then we saw a nice bounce off after that.
Okay, so the tight bars where the very small opening range, not the initial balance where you're talking about that. Yes, right there. Would you be looking at that during the course of the day? And if it gets up over the top of that initial balance of would you say, hey, I think some longs can really defend here? What would you? Okay.
Yeah, because we look at this initial balance and let's kind of eyeball 55 down to 35. So it's a 20 point open initial balance. It's a very relatively small initial balance for the S&Ps. So it's not going to take a whole lot of energy to push this market higher once it breaks out above it. It ran out of time.
Yeah, I got to plot that. I don't plot that, and I think I'm going to start plotting that on my charts.
Anne-Marie, quick question. Maria, could you mind sharing the website, the name of that you were sharing on your screen? We had a couple questions on the chat. I just don't want it to us to lose it.
Sure, it's Edgeful. Edgeful. I talked to the developer of this. He's an ex-Goldman guy. Young fella. I think he'd be a great guy to come on and yak technical things with us because he's an Excel geek. And so I'll send his name over to you guys. He'll be he is just a numbers wonk. And he just wanted to get out of the Goldman rat race. And so I think I think it's a really nice fit. And he might be a pretty fun guest for us, but that's what it is. It's Edgeful, and
Full, Edgeful, FULL.
FUL. FUL. Yeah, I don't understand the name either, but there we go. But yeah, I found it to
give a
be
strategy. You want an edgeful,
yeah, that's right. Instead of edgeless, I guess.
right?
Yeah. So yeah, that's what that one is. So if we could go back to your chart right there, John, and let me just dig through a little bit because I'm going to draw another kind of a TPO thing on Motive Wave and see if I can always keep track of that initial balance, because it might, although I have a tendency to trade well before that, it would be a really nice way to say, hey, I should stay in the trade. And now, of course, Max Maserati's heard his name called 52,000 times since the magnificent trade he had last week sometime, whenever that was. But last week's Thursday, I think it was, something like that. But if we were looking at the breakdown of those things and we go, well, it's fallen through the initial balance of that day, and then it can sort of map out where we might head next in terms of the recent initial balances. And I am just spitballing right here in terms of where it actually started holding traction. I want to see if it has anything to do with the initial balances of times past. So I'm going to build a couple of TPO profiles on Motive Wave and check that range break to see how it did and see if we can use that as something to go, hey, heads up, this is the initial balance of XYZ. You know what I mean?
Well,
so, look.
When the market becomes directional like that, it's going to focus more on naked points of control than extremes of initial balance.
Oh, okay. Now, if we were to talk about why that is it because the market desires to build more uniform looking profiles in terms of where things have been tested, or why do you think these naked points of control become more important?
Well, I think it
Am
comes
I
from
asking the right question?
No, it's a great question.
Okay.
And points of control are comfortable levels. So if a market is out of balance, what is it seeking?
Balance.
So it's going to try and seek out previous areas of balance or comfort when it is out of balance like that. So take a look at the NASDAQ here. Okay, this is last Thursday, right? We ranged, we hung around up here. Max got short up here, and the market fell apart. It went through a weekly kickoff level. It went through there was only one naked point of control, and it walked right through these. But when we get to the low here and we look left, so what was the low? 18,069.
Look at that.
Interesting.
18,069, 18,000. There is a naked point of control down here somewhere because it went right to it. 16 right here.
So you saw this in times past. Now,
yes.
Max was trading the ES.
Yes. Right. Oh, yeah. I was just going to show you how.
But it happened in the NQ also, is what you're saying.
Yes, it did. Yes, it did. Yeah, but it's not showing that right here on this platform because there was I think I was looking at this point of control here, which was 79. This one is 69 right here, and that's that low. But it did actually go through that before. I'm wondering how I had that still on my charts. But I mean, it's still, it's still seeking comfort down at that level.
They are definitely magnet areas when are looking at them. And, you can go back, everybody says like hindsight, but it's not, it's hindsight when you're trying to find the assistant areas, but it's something that you can keep on your chart, even though that, I know you scroll back, that looked like about 10 or 12 days or whatever it was.
Right.
But it just showed that once we built up, came down a little, built a little higher, came down, built a little, and we start making those profiles, especially the P-shaped profiles, we keep going up with it. And then all of a sudden, we need to seek that balance. It was just so far, like you said in the opening call, for like weeks now, John, it's just, these equities are resilient. They just go up and up and up. And then every once in a while, you have that correction where I think you and I'm not a long-term holder like this, but I have a very good agreement with you on this, where a lot of traders, we're seeing that it's a big, giant sell-off. We're done. The market's crashing. I think you looked at it the same way, or a similar way, that it's like, no. It was just, it was time. It just has a correction, and we're going back.
It was time.
It needed to take all it. It was time, right?
We talked all early last week. This market is at risk of changing market state, and it has.
Correct. Right. And patience,
Right.
man.
So-
this is talk about patience. It's patience being in a 10-minute trade. Never mind 10 days.
I mean, here in the S&P, is that low from last Thursday was 51.94. 51.82 half is a naked volume point of control. It didn't get there. Sometimes what doesn't happen is as important as what does, because the following day we open with the opening range at the low of the day, and we rallied.
Yep. That's a key move of yours too. Speaking of opening ranges, where if it's a medium-sized opening range, the opening range is the low of the day, and you stay above it with a little bit of a retest, it's not always, but often
I love
be a trending upward
That's
day,
one
right?
of my, I let that ring in my ears a lot. If I hear John say that, and he'll remind me to go, wait a second, silly, pay attention to direction. And if the low is made at the open, it's telling you we've got directional motion here, right? If it breaks and then holds again and breaks and then holds again, totally different story. But if you are looking at the low of the day coming in at the open, or even the high of the day coming in at the open, like it was on Thursday, last week, Thursday, we saw that, we talked about it, came all the way back down, and that, it's golden. There's some little things that you can keep as the guardrails, right? And one of those is, where was that opening range, and where are we right now with respect to that opening range? For sure. Yeah. And it's easy enough to just throw them on the chart. It doesn't take long. Leave it on there, put a label on it. It'll just be there when you're ready, especially if the market was doing, like John was showing us, up. And then you had that Thursday that took everything out, and just on NQ and ES, just filled the whole, flew right through a whole bunch of naked point of controls. So it reached down to that value area again. And then, those will be way off the chart if you mark them, and as it's getting closer, you're zooming in on your chart and zoom out, zoom in, look left on them, and say, oh, wait a minute, there is something down here.
Yeah.
It's a potential, right? It's a magnet area.
Always
Obviously,
look
something given, nothing.
Always
Absolutely,
look left,
Absolutely.
right? So, this was the 1 minute opening range, and the risk on this was about 88 points. The total range of the day was 66. So the potential, if we held this and got out at the high, like max, huge reward.
Yeah.
But we were talking earlier about expanding the time frame of the initial balance or the opening range. This will be a 5 minute opening range on that day. There's the 5 minute opening range. So that risk becomes 19 quarter, about 15 handles.
Yeah.
Pretty big on ES.
That's big. I can't even imagine what it would be on the NQ.
You want to see?
Yeah. That is something, because it moves so far, so fast.
Yeah.
Right.
Okay, so the thing about the NASDAQ, the opening range was not the low of the session, but if we add time to it, still not the low of the session.
Yeah, maybe the 15 minute. Try the 15 minute.
15.
Barely. There
it is.
That was it.
15.
There it is. But that risk is 182 through 102.
80 points.
80 handles.
80 plus points.
80 handles. Wow. $1,600 risk.
Right. But
Wow.
if you took it and you stayed in, it's worth 280 points at the
Yeah.
high. At the high. How
That's
do
a
you
hard
risk
hold right
80
there.
points?
Yeah.
Yeah. Yeah.
Well, it looks like there's a lot of activity, just a lot of chats and traders in chat talking about different areas of the country. They're starting to see some of this darkness head over their area. So hopefully everybody is having a chance for an opportunity to see some of that. And in preparation for this, I did make a new little background over here we'd like to see, and we'll take a quick look at the markets. But let me get out of the way. Yeah, we
Hello,
know we
darkness, my
love
old friend.
get out of here. Here we go. So this was just saying, give me the eclipse in a futuristic view with a day trading theme. And this is what it came up with. You want to see the irony? This looks pretty good, right? The city, I don't know why they consistently put in these like flying things and flying animal, flying creature stuff. But here's the funny part. Look what it did. It put these X's all over the place. I did not do that. It's like, it's got to be getting a handle on me right now. Something else. Something else like that. Before I kick it back over, could you switch over to my chart briefly? I want to answer a question in the chat before we move it out. There we go. Thank you very much. After showing that YM, because I happen to be on it, traders asked me to just show the same thing on NQ. So this is it. This area here, I use a different one. It looks like here's our gap up. So I'm an idiot. Okay, let's move our gap where it really should be because it's a downward candle. So there's our gap up. We can see it was a 38 drop down. If we did a 1-to-1 on this, we can see obviously we never hit it. But there's our gap. And if we came into this, if we held on to this a little bit down here, it looked like it took from 15 to 7 about 2.5 hours to close that. The gap I'm talking about is the previous day, so Friday's closing price, Friday settlement. And then the open of the Asian market right back to it. The white line here at the bottom is roughly 18,310. That is eyeballing the settlement price. And this line at the top at 18,360, so a 50-point difference. That is the open of the U.S. market. And lo and behold, what did we do? As soon as the market opened, it went right to filling the U.S. close to U.S. session open. It just faded right back into it. So I'm not saying this is 100%. Nothing is. But when the statistics showed, Anne-Marie shared that website, I am dying to see if it's going to do the same thing tomorrow. It's been 100% on that website. So keep that into consideration, right? If it's pulling that gap up and it's filling it 100% of the time at this point anyway, it's not going to do it forever. Just keep it. It's something to keep in mind. And the reason I'm saying this, folks, traders, and you guys too, we all trade different sessions. We know we on fast markets we're hammering away at the U.S. Open. We know Dakota likes a lot of the overnight stuff. We know like Coach Vince that trades some of the afternoons. I do some overnight. I do some pre-market. They're all different ways of looking at the market. But let's say you typically trade Asian Open, and you can't for some reason. Well, try it in London, right? There's always another opportunity. If you miss the gap fade, maybe you get the breakout, the opening range breakout of the next session. You don't happen to get the opening range breakout, you can look statistically and say, well, maybe let's take a initial balance trade. So it's not one size fits all. It's not the same thing every single day. Every trader, every market, every account is all going to be different. We're just giving some examples. That's the whole idea behind this strategy lab. And at this session, it's not a lot of like firing in and out of these trades. That's for fast markets, power hour, and some others. This here, we're talking strategy, and this is what it's all about. This would happen to be about gaps. Anne-Marie is sharing the information she found. Hoag is relating that into some of the other profiles and the magnets of the point of control areas and the different types of opening range breakouts. And you need to adjust and need to adapt to those. We just saw, hey, NQ 1 minute opening range. Yeah, we could do that. If we went to the 5 minute opening range, that might be a little bit too much risk for these accounts that we have. So I just wanted to make sure I reached out and I touched on that NQ, sharing the same thing on the YM. It was a request from the chat. We want to make sure we fulfill everybody's requests. Anne-Marie, what else do you have for us? We got about 10 minutes left. So yeah, run it out for us.
Those are really great points, Robert, in the sense that, so today in Strategy Lab, we talked about ranges and gaps, right? So we have the ranges and gaps. Also, all of this week for the NQ, we can see that all the Tuesday gaps have been filled on the gap upside. All the Thursday fills, the gap downs have all been filled. So
Whoa.
very interesting. So Tuesday, a bearish day, generally, if it gaps up, it fades and fills the gap. Thursdays, if it gaps down, it fills the gap. So super interesting. But what really all we've done today is say, hey, listen, there are some things that happen right near the open that can really help frame out whatever strategies that you're looking for. So the takeaway is this: you've got to pay attention to those opening ranges. And of course, when you're sitting, let's say you have this stat and you're coming into Tuesday and you go, all right, well, my gaps up get filled, and you're sitting here on Topstep and you go, hey, if I happen to gap up tomorrow, it doesn't mean immediately go ahead and go short. What it means is, all right, you look at where it is that it's gapping up. If it's heavy resistance, you can say, I can see why that might be a good area to short. When we give you these instances of things to look at, as newer traders or traders looking for an edge, we have a tendency to go, oh, well, I'm just going to short that. We forget to go step 1, 2, 3, 4. We forget to go through our OODA loop. And the takeaway from all these things we're talking about in terms of gaps and range breaks and all the sorts of things that we've discussed today, just remember, it's got to come back to the space where you go, hold on, I see what that stat is saying, but I don't know, was it Bill Parcells that said statistics is for losers? I don't know, but it sounds like something he would say. So you have to think, wait a second, that's just a statistic. It's not an absolutism. Can I see, hey, we gapped up. Can I see it fading? And, can I see where my target might be, and then enter the trade? Don't rush to these concepts as, oh, this is going to be, my holy grail. Because as soon as we think we have a holy grail, the whole market is going to shift. And all the traders are going to start doing something else. And we're going to have to go, oh, wait a second. That's different. It's just like what John said about 10 minutes ago. He said, hey, we've got a little bit of market state that might be changing. And that certainly is something that we're looking at now. And if the market state is changing, it means that price action can shift. And so we just have to pay attention. Again, price, 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 price.
Well, I'll echo that same sentiment that statistics, they are statistics. And just because it happened before, it does not mean it's going to happen again. But there's a thing called probabilities that we go on. Mm-hmm. You just shared probabilities, Anne-Marie, of on Tuesdays, if it's a gap up, it's nearly 100%. It was 100. It's going to fill that gap.
Yeah, it has been 100% since January.
Yeah. Awesome, 100%. And what was it in for the Thursday gap
Let's
up?
See what it is for the, yeah. Thursdays on gaps down, they get filled to the upside. And then on Tuesdays, gaps up get filled. So it means that things are moving downside. But let's go to a year and see how that shifts. Right? Still 75% of the gaps up get filled in a whole year. And then on Thursdays, let's see. So It's really, these Tuesdays and Thursdays are statistically significant in terms of Thursdays being more bullish and Tuesdays being more bearish. Right?
When there's a gap present and we're only looking at one data point, we're not looking at anything else. Like, was there news? Was it a holiday week? Like, none of that stuff is there. This is one data point, and it is very, very impressive I'm going to quote Hoag on this before I kick it back over here to his comments. And from what you were saying earlier, Anne-Marie, Hoag, you're right in front of me, man. I'm going to quote you on this one. Just when you know the answer, the market changes the question.
Exactly. 100%. Oh my gosh. Don't you wish that wasn't true? But it is.
Boy,
it is true. And
it is something else.
You got to embrace it. Embrace it. And just manage the risk.
If we know
I get so much out of listening to Nick. Exactly.
Right.
I do. I get so much out of shoulder tap. And it's all about managing that risk. If you manage the risk, you can live to trade another day. Just don't go out betting the farm. And if you think that you're not like that, but you actually are, you really have to look at yourself in the mirror and go, hang on, am I working in the market like I'm buying lottery tickets? Or am I working in the market like I'm building a business? And that's so important, right? Because they're two totally different mindsets. And trading for a long time, I've met people that really are on both sides of that, whether they want to, whether they want to say it or
believe
not.
it or not.
Yeah.
Yeah. Right. I would love to see more of a data point on those. We just saw that we went from 100%. You went back for a year, and it still was up there on both the gap up and gap down Tuesday to Thursday. Now, imagine if we just pulled some of the data out of that and said, well, what is of those days that it didn't close? I'm going to throw a total random number. The gap happened to be over 100 points in NQ. Okay. So now we just add that to it and say,
gotcha.
Oh, here's a gap up.
Gap
it's
size.
less than 100 points. We're going to reduce the amount. And this is just speculation. But imagine looking at the reasons when it didn't fill. Is there a commonality on that, right? And the potential in there. I know that when I do trading and a big adjustment I made, I do this mathematical, my own brain algo calc. And if my targets were more than 20 points, I was losing 80% of those. I no longer trade targets more than 20 points. That's the point I was making with what you were showing. That. I would love to see some more data behind that as to, okay, we didn't lose a lot of them, but of the gaps that didn't follow that procedure of filling, be really curious to see it. I saw that they were in the chat, so that'd be wonderful. Yeah, that's wonderful. Yeah, John, you got a couple minutes left. I'd like to give you the last word, sir.
Can you ask him? When we're talking about gap fills to settlement or the last price, how much of that is due to overnight inventory adjustment? In other words, it's the shorter time frame, weaker hands traders that are moving price away from that level overnight. If they don't get what they're looking for, they bail and they bring price back to settlement to close that gap.
So do we think this might be a measure of volume?
I think it can do a couple of things, because what do we have? There's certain things. We have contract rollover, which can be hairy. We have holidays, which are going to throw a different thing as well. When they have that extra day. Now, whether the holiday is closed on a Friday or closed on a Monday, maybe that has something to do with it. Or maybe it's just, if it's been up for 5 days in a row and there's another gap up, it just doesn't fill. I don't know the answers to those, but those are their hypothesis, their questions we need to throw into the mix just to get us a little bit closer to that better probability. But man, that is still really, really cool, really good.
Very interesting, right? Yeah.
Tuesdays and Thursdays. Yeah. So at the very, very least, Anne-Marie, with what you shared, if the market gaps up and it's a Wednesday, maybe I don't touch it. If it's Tuesday, I'm going to take a shot.
Yeah, exactly.
Way to go.
Exactly.
Way to go, folks. Any last words? We have about 1 minute left. Real quick for both of you, then we'll sign off. We'll get out into the Power Hour with Master Adobe, Coach Jay, and actually David Green is going to jump on too. So Anne-Marie, close us. Give us the last minute here, and then we'll sign off.
I hate to be a broken record. Just manage your risk. I hear Mick talk about how many days people last in a live account, how many days they get to the FXA and XFA and blowout. And it makes me go, pay attention to your risk. Pay attention to your risk. And if I'm sitting there going, pay attention to my risk, maybe that's something that we should all be thinking all the time. Hey, I need to pay attention to my risk, and I have to send that mantra to myself because I'm always swinging a little bigger, because it's fun, but I've been tapering that down, and it looks like I still need to taper it down.
You're a gunslinger.
I am calamity end.
It's always nice. It's always nice to hear that again. It's not really a broken record. We have so many traders coming in and out of chats and watching the show. It could be 2 months from now. Great to hear it again with manage your risk. And as I always say, we have entries, targets, and stops, right? We know our entry because we put it on. We know our stop because we know our risk. We don't know the target, but we get the best that we can with it. All right, folks, that is going to do it for us. We have Jovi is going to take control of the power hour. It's been a little rangy here for the past, well, it looks like around lunchtime has got it. Coach Jay is going to be on. I love that guy. And of course, David Green is going to be here as well, giving his expertise. That guy is a walking encyclopedia of knowledge as well. We're happy to have all of us on there. Hope we can get outside. It's starting to darken up a little bit here in Mass. And everybody else have a great day. Thank you both for being here again. Love it. And we will sign off now. Take care, everybody.